What is an escrow account? Why do I have to collect so much money for it? Is that a closing cost? Should I escrow or not? These are all kinds of questions that we get, and my hope is to answer them in short videos, if I can do it, here in this several part series. Who knows how many it will be. Hi, I'm Andy Tuttle, your friends in home finance. And hey, if you like friends and your home is financed or you plan to finance your home, stay tuned. We'll do our best to help you out and give you some good tips along the way. So an escrow account, to start this off, is simply an account that is set up, tied to your mortgage payment, that money goes into partially from your total, what they call budget payment, PITI, principal, interest, taxes, and insurance payment, set aside for those property taxes and homeowners insurance every month. In other words, it is set up so that you can pay one payment a month. Part of that goes to principal, pay down the loan. Part of that goes to pay the interest on the loan. Part of that goes to a side account for your property taxes. And part of that goes to that same side account for insurance. That side account is the escrow account. You're able to see it on your mortgage statement. It will have an escrow balance and it'll build throughout the year. And then when your homeowner's insurance becomes due, which will be always 1 year from when you closed on the loan. So if you closed in August, well, your insurance is going to come out of that escrow account the next August. And you're always paid up a year in advance for insurance. You always have to be insured ahead by a year. Whereas property taxes in the state of Texas are paid at the end of the year. The bill comes out in October. Lenders typically pay those on your behalf in December or January because the taxes are due by January 31st of that year for the previous year. So that is the main difference between insurance and taxes. Insurance is paid ahead, taxes are paid behind, and that escrow account is a side account that is set up, that builds up throughout the year. And then when the time comes for those property taxes, which cover county taxes, jurisdictions due, city, schools, hospitals, all the municipalities that have to be paid, that is paid out of that account. And you either have extra in there at the end of the year, or you have what's called an escrow shortage, which we will talk about in future videos. But in the beginning, when you buy a home, you have to collect enough to fund that account, because when you buy a home, you don't make a payment for between 30 and 60 days, depending on when you close. So you're already behind on those tax and insurance collection payments. So when you close on a loan, you actually collect for, in addition to your closing costs, 1 year of insurance in advance, and because that's got to be paid right away, and that's called your premium. And then you set up reserves, typically 2 to 3 months for property taxes and 2 to 3 months for insurance, that when you close, that money is set aside and goes to start funding that escrow account. If you have any other questions on that, we're just a phone call away. We have many other topics to cover in our next videos on escrow. If you need to do them, should you do them, and why do you have to collect so much on refinance? That's all I got today. Stay tuned and hope you have a wonderful day.